Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome to Keen on Retirement. I'm your co-host, Steve Sandusky, and with me today, Bill Keen and Matt Wilson. Hey, guys, how are things?
We're doing good, Steve. It's long time no see, as they say.
That's right. Yeah, we were actually in person together just a few days ago down in Orlando, Florida. The three of us were at the Barron's Independent Summit. So many of you may be familiar with Barron's. They have the Barron's magazine, and they also have a division that does a lot of work with financial advisors, and they put on a series of events each year for high performing, highly successful financial advisory firms. And you two were representing Keen Wealth, and I was there as well as a co-host of the Barron's Advisor podcast, and had a great event, lots of great sessions, lots of good learning there. And we also recorded a podcast, the three of us, that will be coming out on the Barron's Advisor podcast. And you guys were invited to participate, be guests on the show, given the great success that you've had here at Keen Wealth Advisors. So that particular podcast is really designed for a financial advisor audience that wants to hear from some of the more successful advisors out there and what it is that they do that makes them so successful. So it was a real treat to have you guys as a guest on that show. And of course, always great to see you in person.
Yeah, well, thank you, Steve. We were comfortable with our interviewer that day, since you are the co-host of the Barron's podcast as well. I don't know if our listeners realize that, but I've always said that you're somewhat of a celebrity in our industry of financial advisory and financial planning. You've been around a long time. You're a CFP, a 30-year plus veteran, and host of the Barron's podcast and of the Keen on Retirement podcast as well for in our 230 something episode. So
that's right. Yeah. So it was fun to record the show. And Matt, we had all three of us, we went to some really insightful sessions. Of course, there was a lot of talk about the new administration and some of the policies that are coming out, and certainly a big change in direction for the country with the re-election of President Trump. And there's a lot of chatter about that. And Matt, why don't you kick off here? I think that sort of leads into the topic that we want to talk about here today.
Yeah. That was definitely, one of the big talking points during some of our sessions was just the impact that the tariffs are having on the markets. I mean, if the markets weren't going down, it would be less of a conversation. It's just the fact that the markets are going down, and it's common to want to put what's the reason? And a lot of times the reason for it may not even be what's in the news. However, in this situation, it does feel like there's some clear things that are kind of tied to the tariff conversation and the policies. Now, I'll expand more on this in April during our market update webinar. We've got an hour, and I have a lot of charts and graphs that I show during those. And so we'll go through a lot more detail, but this is not new. So that's it. During Trump's first administration, he instituted tariffs in 2018. And, how quickly do we forget? But the market in Q4 of 2018, I mean, it's down 20% in Q4.
Right. And, I was going to say, I didn't want to interrupt you, but as we record this today, where the Dow's at 42,000. So you said the market's going down. I mean, it's down a little bit, but it's not like it's gone into free fall or something. So, and we were, the market takes 2 steps forward, 1 step back, 3 forward, 2 steps back, 1 forward. So we're just kind of in one of the 1 step back. So at this point.
Yeah. So during 2018, we had tariffs instituted. So let's talk about kind of what happened back then. So the U.S. imposed a 10% tariff, and then it was increased to 25% on roughly $370 billion worth of Chinese exports. And the rationale was around unfair trade practices. Some of you may recall, a lot of conversation back then of intellectual property and how us in the U.S., our laws, how they kind of look at and view intellectual property, and how China doesn't necessarily view it the same way. So the tariffs were put in place because of that. And then China retaliated. So then they added a 5 to then 10% tariff on roughly 75 billion of U.S. goods, and that was targeting mostly like soybean, autos, and energy. That was the big area that they were targeting. And the reason the market went down is because that is a in the very short term, it's just, hey, all of a sudden it's like prices just went up. I mean, that's really what that's indicating. And if prices go up without a offsetting increase in GDP or increase in wages, it's like it just costs everybody more money, which is less money to go somewhere else. Because the tariff is it's a tax, is what it is. I mean, that's the best way to think about it. It's a tax on those goods. And yeah, there's reasons behind that, whether it's to protect U.S. industries, make sure certain jobs in areas that are what we would consider, significant to our economy, that aren't just getting, destroyed by some cheaper alternative that isn't necessarily based in the U.S. So it's, again, there's reasons for it. But yeah, I mean, so post that, we had market go down 20% 2018. Well, what happened? Well, this is your point, Bill. It went back up. It didn't just stay down 20%. Now we're just 20% less than where we were because of these tariffs. I mean, it went right back up. I mean, and we had COVID, and then COVID, it went right, things come and go, and markets react to them. Companies adapt. So what happened is a lot of U.S. importers, they shifted their supply chains. This was back in 2018, 2019, from China to other countries like Mexico and Vietnam, because that would not have the same impact that, that manufacturing in China would. So that was some of the things that happened. Certain U.S. industries benefit. So domestic steel makers, for one, they had some protection because there was a 25% duty on imported steel. But even that, it still proved temporary. So there was steel and aluminum plants that were reopened in 2018 that still didn't necessarily stay open. So while there was some short-term benefit, not necessarily long-term benefit. And this lasted till roughly around 2020, where there was a phase one of a trade deal where China agreed to buy 200 billion of U.S. goods, but then COVID hit and that kind of threw a wrench in all that stuff. So, and then under President Biden, it just kind of stayed the way it was. Wasn't much of anything until now. We have President Trump in office, and his agenda now is back on the tariffs and talking about, China, and then even Mexico and Canada and all that has been, discussed here over the last couple of months. But the biggest issue is that these are significantly larger. So it's a 10% tariff on all U.S. imports. So that'd be 2.8 trillion in goods from all trading partners. So in 2018, it was 370 billion from China, but now this is kind of across the board. And that was, the 10% was enacted in February and threatened to increase to 60% if China doesn't concede to, certain demands. But it has since doubled. So it is currently at 20%, the tariff. And then Mexico and Canada, there was a hold there in February, and then back in March, those did come about. And so there's a 25% tariff on imports from Canada and Mexico. So that's all kind of where we're at today. And, I think the reason the market's reacting the way it is because there is not a clear, at least to the market and the market participants, there's not a clear plan. What is the objective of the tariffs? Is it to bring back more jobs in the U.S., protect U.S. jobs? Is it related to fentanyl, that was early conversations around the tariffs, especially with Canada and Mexico, was, hey, your borders aren't secure enough. You need to make them more secure, and we're going to threaten these tariffs until you comply. So, I think the market is more reacting again. It's like how we say this about a lot of things, but it's about the uncertainty around, is there a plan in place? And because it definitely seems like the administration is shooting from the hip, so to speak. They're just kind of saying, hey, all of a sudden it goes from 10 to 60%. Like that's a big difference. And that would definitely be surprising to the markets, because tariffs were talked all about during the campaign. It wasn't like this was new. This didn't just come out of nowhere. It's just the fact that this kind of feels like there's no structure around the purpose of it. And now maybe that could definitely be on purpose by the administration, because they don't want to have a worse position when they're negotiating. They want to have, power to negotiate. So they don't want anyone to really kind of know what their purpose is. However, the markets are reacting in a negative way to that currently.
Again, just to kind of go back, thank you for that explanation, though. I think that was the most succinct kind of explanation that I've heard of all the media that I consume, which isn't as much as it used to be anymore. But going back to 2018, the market, the Dow closed the year at 23,000, just over 23,000. That's end of 2018, and end of 19, just over 28,000. And despite all that uncertainty back then, we sit at, like I said, 42,000 now. So imagine if you would have been on the sidelines this whole time, worried. And oh, by the way, COVID happened between those times and today. So speaking of the resilience of these markets and the resilience of companies to figure out how to make money, regardless of who is in political office and what relative taxes and regulations are, it's a powerful mechanism that we've seen play out again and again and again. But thank you for your summary of that.
Yeah, and I think a couple things too here, to your point, Bill, about companies find ways to make money. Mm-hmm. At the end of the day, that's what the market cares about. It cares about, with these tariffs, the market participants may or may not like the idea of tariffs, but at the end of the day, they're going to put their personal opinions aside, and they're going to look at, how does this affect the companies that we invest in? Mm-hmm. And over time, if companies will figure out how to maintain profit margins, or maybe even increase profit margins as a result of this, then stock prices will probably do fine. Because again, stock prices are based on earnings. And if earnings longer term are not going to be negatively impacted by this, then market participants are typically going to look past these tariffs and say, hey, ultimately, companies will figure out how to make money and it's going to be okay. So let's not sell our stocks indiscriminately because of this.
Yeah. I mean, we're talking about the markets, like the S&P and the Dow, those are kind of generic benchmarks that the media uses. And the S&P's down 10%. Well, that doesn't mean everything is down 10% across the board. There's certain areas that are down more than that. And it is, I think people that are paying very close attention to the news and to, the headlines around tariffs, the areas that are hit the hardest are kind of the ones that are subject to these tariffs more than anything else. I mean, you think about the automotive industry and the manufacturers. They import from Mexico and other places, and so those tariffs are going to impact them. But there's other areas that very little. I mean, think of all the things that you as an individual, you purchase from here just in U.S.-based businesses. So all that stuff isn't impacted. So when we look at it, it's like there are definitely areas of the market that really actually this year may not necessarily be up on the year, but are flat for the year. Those, certain sectors and industries like consumer staples. So that's the stuff that we buy no matter what, whether the market's, whether we're in a recession or there's an economic expansion, you're going to go shop for groceries. I mean, as far as I know, you can't survive without buying food or consuming food. So you're going to have to do that. You're going to pay your utilities for the most part. These things and those areas, utilities, again, consumer staples, they've held up well. Whereas technology, and especially, technology is a very broad basket of companies, but you've got chip makers and they definitely are impacted by the tariffs more than a company like Netflix, but they can be all considered technology stocks, so they get kind of lumped together. And that is, just something to be aware of, that just because the overall indices are going down doesn't necessarily mean your portfolio is going down or even close to the same level that the overall benchmarks are that the media is talking about.
One thing that you said a little bit earlier, Matt, that I want to go back to for a second is you talked about the uncertainty that these tariffs generate on the part of businesses and the lack of clarity on what is the ultimate objective of these tariffs. And I think one of the things that President Trump has talked about in terms of an objective is bringing manufacturing back to the United States by making it more expensive to import. That might encourage companies to reshore or onshore manufacturing back in the U.S. I think most people would say that's a pretty good objective. I think what makes it difficult for a lot of businesses, though, is they're trying to figure out if we make a decision to relocate or to build a new plant in the United States, that's a big decision.
Yes.
That could be like a multi-decade decision. It could be hundreds of millions of dollars, could be multi-billion-dollar decisions that are very strategic in nature. And so I think there's a lot of concern in the business world about, okay, is this the new environment that's going to be in place for many, many years? We're going to have these high level of tariffs. And if so, well, maybe it would make sense to try and bring this stuff back to the U.S. But if this is more of a short-term negotiating type thing for geopolitical reasons, then maybe I'm just going to try and run out the clock here and see if we can delay making some decisions and just see what pans out. So I think that's a lot of the tension that we see in the marketplace right now in the financial markets is this push and pull with, is this long-term and I can make good long-term business decisions based on it? Or is it just shorter term and I just have to sort of, like I say, play out the clock here, run out the clock and not make any major decisions until there's further clarity? That type of uncertainty is unsettling for a lot of the leaders of these big companies.
Yeah, no, that's very real, because those and as you mentioned, they can be multi-decades. Yeah, it's like you can't just turn on a manufacturing plant in the U.S. It just doesn't work that way. I mean, in some cases, you might have one that's less underutilized if you have one, but outside of that, it's an expense too. So there's now an investment that has to be made, and there's a return on investment that investors, that's where all the analysts and all the research, they're trying to figure all that stuff out in terms of what that look like versus, is there another country that maybe doesn't have the same impact that these tariffs have that they could shift their manufacturing to? Because that's another potential option. Similar in 2018, it was all focused on China, and a lot of manufacturing moved to Mexico, which was great for Mexico. Until now, Trump
now the tariff on Mexico.
Yeah, it's like
and a tariff on Canada.
Yeah, those things they come and go, but it's like it is uncertain, because if there was a clear path, then investors, analysts, researchers, they can figure out what's then the path to profitability, or at least come up with their analysis on, well, how do we get through this? Well, you don't know how to get through it if all of a sudden the tariffs are going to be 60%. I mean, that's a huge scenario change to then start to figure out all these different paths to profitability based on the current take on the tariffs with the administration.
Yeah, another thing that I think is also in the mix here, and any of these kinds of decisions, you can't make them in a vacuum, because every decision is related to a whole bunch of other things. And just to give you one example here is the government just released some data here in just like in the past week from when we're having our conversation today about the fertility rate in the United States. So this is the fertility rate is essentially the number of births per 1,000 women. And so the fertility rate in the United States in 2023 was 1.6, which means for every 1,000 women, I think of childbearing age, there were 1,600 births. Okay. Now the replacement rate is 2.1.
Yeah.
Which means for us to maintain our population, that fertility rate needs to be 2.1. Well, it's 1.6 and has been below 2.1 for a long time, and it's continued to decline. And so as we think about if we want to bring back a lot of manufacturing to the U.S., we've got to think about, and this is what the business leaders are thinking about. It's like, am I going to have enough employees to staff these companies? And I look at fertility rates. I look at what's happening with immigration. You know, that seems to be going the opposite direction. And so it's like, where am I going to find the people here? And so again, these are all complicated decisions, and it makes it really difficult to be a leader of a big company these days.
Yeah. And along those same lines too, it's like there could be a segment of the current workforce that is, you know, underutilized. They're not paid the wage that they, you know, should be paid, whether it's because those jobs don't exist. You know, the jobs that they have access to don't pay the wage. And will that, you know, having a manufacturing job, more of a skilled labor type position, yes, pay more and provide that opportunity for these folks. There's definitely people that are like that are out there, but it's just how many are there? You know, that is not a thing that's very easy to quantify. So it's, you know, yeah, we can say we're going to create all these jobs, but that doesn't mean the jobs get filled.
Right.
You know, at least to the level that we want.
Right. And to get them filled, if I have to pay higher wages to draw people in, what happens then? Well, that leads to inflation. And what happens with inflation? You get really unhappy people, right? And there's other consequences, obviously, if inflation is up. And so again, there's so many interrelated factors here that I think it's important for people to really understand. There's no simple answers to complicated problems.
That's right. I mean, it is complex. And you know, one of the things too that one of the speakers that we saw at the conference was mentioning was that one of the theories that they have is that the administration is wanting to increase basically the wage base of the low wage earners in the U.S. So by bringing back higher quality jobs that pay more. And while, yes, there's trade-offs with inflation, the concept being, hey, well, is that just better for everyone that all of a sudden there's this demographic that's maybe below the poverty line that can get above the poverty line, which then maybe is less government assistance and other things. So, you know, again, it's like they're trying to figure all this stuff out because it's not being communicated by the administration what's the objective. And I think, you know, it's hard to say based on you know, what we know at this time. Now the reality is we can talk about all this, and we could probably talk about this every single day until it's not a thing anymore. So the takeaway is, okay, well, what do you do about it? You know, people as consumers, they may not buy certain goods because they can't afford them anymore because there's a tariff related to that. But from an investment standpoint, it's like, okay, so what do we do about it? Well, you know, us at Keen Wealth, I mean, we make adjustments to the portfolios based on, you know, certain things that happen, and definitely look at these pullbacks as opportunities. That is, you know, how we view market corrections is definitely opportunities, because every single one of them has been an opportunity. There has not been one market correction that went down and stayed down or led the whole market to zero. It's never happened. And while you're diversified, you own all these different assets.
In the U.S.
In the U.S. And individual companies can go to zero. Diversified portfolios, you know, assuming you're diversified correctly, that's kind of a, you know, broad term. But when you're diversified correctly, it doesn't eliminate downturns, but it also, it does protect it from a permanent loss. That is one thing. Now, what can create a permanent loss is human reaction. So how do we react to what's happening? You know, we haven't had a lot of we've had clients asking about what's going on, but not necessarily cause for panic. And I think primarily it's one because while this, again, it's getting attention in the financial media, overall, indices down 10%, diversified portfolios down significantly less than that. And even, portfolios that we manage for our clients are holding up very well relative to those benchmarks. So, I think that's definitely playing a part because not everything is going down. It's just, certain areas are, but not everything is.
I want to share something from one of the speakers at the Barron's conference that the three of us were at, and I think you two were in the audience for the speaker. I think it was it wasn't the first market outlook panel, but it actually was a private equity panel. And one of the speakers said, the way that you destroy value is by being a forced seller.
Yeah.
And the reason why I want to bring that up here is because when markets are dropping, there are times when investors will panic and they'll say, get me out, I can't take it anymore. The market's dropping, I'm losing money. Well, anybody that's working for that's a client of Keen Wealth Advisors is not going to be a forced seller in the sense that if markets are dropping, they have to sell. Okay. So if they decide to sell, it would really be an emotional based decision. Right. A forced seller would be someone who, let's say they are a business owner and they took out a loan from the bank and for whatever reason, something's going on in the economy, the company's not doing as well. So the bank decides, we're going to call in the loan. You have to pay back the loan now. The company says, we don't have the money to pay for it because there's a recession going on, our business is down. And so now they're a forced seller to sell something at an inopportune time. That's a forced seller. That's going to destroy value. And so I think it's important for investors to realize that when markets go down, in most cases, you're probably not going to be a forced seller. There's nothing forcing you to sell at that point, like the business owner who's getting a loan called by the bank.
Yeah.
And I think that's where one of the greatest values that a financial advisor provides is helping investors understand that, hey, we've planned for this. We have helped you put together big cash reserves. We've salted away 6 months, 12 months, 2 years worth of cash so that even if you had zero income, you're still going to be okay. We've segregated your investments so that we've got different time horizons for different, pots of assets here. So we've planned for these times. So don't be an artificial forced seller to destroy value. Yeah. And so I thought that was a really important insight from that gentleman. And I think it's important for investors to realize that. Don't be a forced seller when you don't have to be.
No, that's a great point, Steve. And it's like we set up exactly what you said. We set up portfolios, especially when clients are at that retirement phase and they're taking distributions out. There's no more inflows. Like you're young and saving. Hey, markets go down, they go up. Your dollar cost averaging in, it's great. Less concern there. But now you're not putting money in. Now you're taking money out, and that's definitely a different portfolio strategy. And we don't want to be forced to sell stocks at a bad time. So there's enough set aside to get us through these downturns. And there are situations where investors can become forced sellers. None of, our clients don't utilize this and we don't utilize it for them. But there are ways that investors can take loans against their investment portfolio. They typically are called margin loans. There's other versions, but margin is the most common. And when you go open up an account, just FYI, if you open up a brokerage account, so a non-retirement account at any of the custodians, I think margin is defaulted to being added to the account. Because if you happen to draw against it, it's interest that you're paying that the custodian keeps because they're the ones kind of giving you the loan. And the interest rates, just so you know, are not good. I mean, they're not credit card like, but they're definitely high.
And your assets are the collateral.
And so that's where the forced selling comes in. And this is something that, it's one of the things that I look at is like, okay, how much is on margin? Because that is stuff that is reported. Because when markets go down enough, whether 10% isn't necessarily enough, but is it 20, 30, 40%? then you've got these loans are called, these margin loans are called, and unless you have outside cash, you have to sell the investment to pay the loan, which just almost consumes the entire account, or can consume a very large portion of it.
Because in that scenario, by definition, it's at the worst possible time.
Well, exactly.
Collateral's worth the least.
Yeah, the banks don't call collateral when things are great. They want to extend it.
They want to give you more.
Exactly.
We're not purporting this, by the way. We're not recommending this. Matt's just using this as an example.
Well, because it's like, because it can happen, even to investors. Same concept that Steve mentioned as a business owner. I mean, but people can leverage up their portfolios, and when things are going great, they might think they're the smartest person in the world, and then when it's not, that's not good. And we've heard horror stories. People come in and see us sometimes, and they tell us like what they did or what happened, and it's like, it is what it is. You just have to kind of restart and get through all that stuff.
That's right. I'm thinking about the perspective here. I'm looking at a chart that Morningstar has put out, but going back to before 1926, let's call it 100 years, small cap stocks that are smaller in nature have returned somewhere around 11.8%, large stocks around 10.1% on average now. Government bonds about 5.2. Those are midterm bonds. Treasury bills, which are very short-term bonds, have returned about 3.2%, while inflation has been just under 3%. Long-term returns do not come in a straight line. Maybe the Treasury bills come in more of a straight line, but the other returns certainly don't. But we're talking about through things like 1929, the market crash, through Pearl Harbor, through the general agreement on tariffs and trade in the mid-40s. We were talking tariffs back then, through JFK being assassinated, through the start of the low inflationary period, and then the massive inflation that we had in the late 70s and early 80s, and the crash of 87, the Gulf War. I obviously could take more time, go through all these things that have happened in that time frame, bringing it back to the averages, and why we talk about it at all, even on our program. Why are we talking about tariffs and these policies and the economics and the markets at all? Well, it's because I always say, and most of our shows, for those of you that are longtime listeners, will realize and remember and recognize, majority of our shows are about the planning aspect to what we're doing here in the someone's financial life, minimizing taxes, looking at spending, looking at making sure Social Security is maximized, pensions, things are titled appropriately for estate planning purposes, updating that on a regular basis, always knowing where you stand, having truth about where you stand, and keeping things updated. So the planning aspect to this is, I don't want to say more important, because there's an engine to the plan.
Well,
and the engine
is
the
plan.
Investments.
You have to have an investment plan.
That's right.
Well. There's a plan. Yeah. There's
a plan.
Yep.
Correct. There's a plan on both sides of it. And the markets are what we participate in. The capital markets, we can call them, stock and bond markets, are what we participate in as the engine to our overall life and financial plan. And that's why we talk about it and help folks get perspective on it. So you can go detailed, or you can back up and say, which is important, or you can back up and say, what is the reality about how things have worked long term over many different cycles and time frames.
That's right. And we know plans can blow up for a few reasons. It can be overspending. That's definitely an issue that some people face, and it's just the funds are not going to last, no matter how great the investment strategy is. There's just only so much that the investments can do. But another reason is the emotional reaction to the investments. And that's why we talk about it, because it's like, well, we can control how we react. It's hard sometimes, but we can control that. We can't control the markets, but we can control our response to the markets. And, that's the important kind of takeaway. It's like, we're in control of our response. So how do we use this to our benefit? And that's how we always look at these pullbacks.
Mm-hmm. That's right. I mean, I think about too, we talk a lot about this, the history of, the terminology, like we have a lot of terminology in our industry, and we call it bear markets or bull markets. We like bull markets. Bull markets are when things are going higher. Bear markets are when things are going lower temporarily. But by definition, a bull market is when a market establishes a low reached after the market has fallen 20% or more from its high, and then from that point to the next market high, that's called a bull market. And a bear market is when the index closes at least 20% down from its previous high close through the lowest close reached after it has fallen 20%.
So they don't tell you at the high that now it's a bear market. It's
no
after
one tells you till
20%.
after, by the way. You have to look back and say that was that. That's when it happened. But when we look at these things over the long term, again, this is another, again, on our YouTube channel, we'll have this superimposed on the screen at this point in the program. There's a chart that's wonderful that First Trust has put out, and it talks about the average bull market period has lasted 4.3 years with an average cumulative total return of 150%. And the average bear market has lasted 11.1 months with an average cumulative, and I always add this word, temporary decline of negative 31%. So we're talking about the preponderance of the time. And if you see this chart, you would see, oh my gosh, the above the line, the bull market absolutely dwarfs the bear market periods. But folks can get, and the media will play to this because fear sells. Yeah. I got to avoid the bear. I got to avoid it. I got to figure out how. And they end up missing or completely messing up the participating in the long-term power of the capital markets, which is why there's not more multimillionaires in the United States. It just takes starting early and being consistent and adding money. And during times of these temporary declines, at times of decline, at a minimum, not selling out your good investments, but maybe even adding to them when you can, and just having time, having that seed planted and having time, which is a wonderful thing. But there's no training on this. That schools don't teach this. No one really teaches this. I mean, the media does the opposite, in my opinion. They try to scare everybody with some of this stuff. So there's a real balance when we're speaking about it on our programs of going deep into the details, and because we want to share that with you, our listener and our viewer, but we also want to bring it back and provide perspective too for what we're actually doing here and what the objective is and how we maintain a long-term plan and stick to it, and where that intersection comes together.
So speaking of fear sells, here's an interesting statistic. In the last quarter century, so basically from 2000 to today, gold has risen 10-fold.
Yeah.
The S&P 500 has risen 4-fold. And what's interesting about that is a lot of people don't invest in gold because it doesn't pay a dividend, it has no interest, and it just sort of sits there. And a lot of people in times of fear will feel like, okay, I need to own some gold because it's a store of value and it's historically for thousands of years been viewed as something that's worth value and it'll keep up with inflation. So for the past 25 years, 10x return versus 4x for the S&P 500. Now you might say, oh, wow, that sounds pretty cool. Maybe I should invest in gold. But if we go further back to 1980, when it hit a peak of around $800 and some per ounce back in some high inflation days, if you flash forward to today and you look at the inflation adjusted price of what gold would need to be today, based on an $800+ price in 1980, if you add inflation over all these years to that price, here's a quiz. What would gold need to be today to have kept pace with the inflation adjusted price since 1980?
I'm just going to throw this 5,000 an ounce. Throw it out
5,000? Okay.
I think Bill, that's a good guess. I'll go 5,001 if there's some sort of a contest we're going for here.
This is like the Price is Right. You can't go over.
That's right.
It's actually 3,800.
Okay.
So as we're talking today, the price of an ounce of gold is about $3,040, $3,030-ish. And so even though it has increased tenfold in the past 25 years, on an inflation-adjusted basis, it's still below its peak back in 1980. So we always, a lot of people think gold is a good inflation hedge, Well, it's still behind inflation going back to 1980, even though in recent times it's actually done extremely well. So I don't know where I go with that, but I just think, a lot of people understand gold. And it's just interesting to see, well, how has gold actually done over a shorter and a longer period of time? And has it kept up with inflation? Well, since 1980, it actually hasn't.
Yeah.
That's right. And we also, speaking of gold, we get those questions about owning the physical commodity. And we've talked in prior shows about, when there are times of turmoil, you hear all the ads start picking up on all the the radio shows and things, Rosalind Gold, and you got to do this and that, not to give them a plug or anything. There's many others. But if you're buying, and I don't even know how they operate, if it's physical gold or not, but if you actually do have physical gold worth anything, you've got to make sure it's appraised. You got to make sure it's stored. You got to make sure it's insured. You have to transport it to introduce it back into the system. You have to do the reverse of all that, transport it. You have to ship it, insure it, all those things. And so there's a cost. There's a cost to those things as well, not to mention the spread or the bid-ask spread on some of those things. So we're open to asset classes and those things. But when we look at portfolios, we always say, what do we need to do? What do we need to do to get to our destination? And that's where we begin our evaluation process with the traditional liquid capital markets.
Mm-hmm.
Not having too much in any one thing, any one sector, any one security. Some of those basics that people don't think are that exciting, maybe, but they do think it's exciting when they get to live their life and they don't have, and over the course of a retirement, have the income they were expecting, and not worry about having part of their portfolio or all of it maybe blow up because of some overconcentration or somebody, certainly doing all or nothing type moves. Those are very damaging. I would, someone that says, hey, I want to have 2 or 3% of my portfolio in precious metals, commodities, or gold would be a very rational thing to say. But somebody who said, I think I'm going to sell out my entire portfolio and put it in gold, that's not rational. I understand as a human, you might have fear, and I can acknowledge and honor that, but that's not healthy for your financial plan.
Yep.
It's interesting, though, some of those conversations that we have to have, and not that often, right, Matt? I mean, really, because I think the work that we do on educating clients with our thought leadership around podcast, the books that I've got out, the blogs, the webinars, the shows that we do, the in-person trainings, the folks that we attract to our program are people that are educating themselves. And I think while we're all human and we have a disposition to maybe react emotionally, we'll never be rid of that, which is fine. The idea of the all or nothing thing, we don't come across that too often, I don't think, do we?
No.
Our work.
Yep.
Yeah.
Well, as I summarize what we talked about here today, I would say I've got a couple takeaways. So one is, as it relates to the tariffs, obviously it's getting a lot of airplay. It's making a lot of noise out there. The markets have certainly been affected to some extent. But the way that you guys are looking at this is, hey, we've been here before. We've had tariffs before. We've had a lot of noise in the markets before. And at the end of the day, the markets are going to be moved based on how what's happening is going to affect the earnings of those corporations. And so right now, the thinking is that there's still a lot of uncertainty. We're not going to make huge bets on anything because we don't know exactly what's going to happen. But ultimately, companies usually find a way to continue to make decent profits, which are going to be reflected in stock prices over the long term. And since we're investing for the long term, we're looking at the long-term picture while understanding there could be some turbulence along the way. And you guys obviously monitor the situation. And if it looks like there are going to be some long-term impacts, well, then you'll make some adjustments accordingly based on, each investor's individual needs. So I would say that's one thing. A second thing, based on what you just said here a moment ago, Bill, is that when it comes to what are you investing in, I mentioned gold, and I didn't mention that because I think everybody should own gold. But I think your point is really well taken, which is we start with, what does the client need? What does their plan need to achieve the objectives that the client is trying to achieve? And typically you can do that through the liquid investment markets, whether it's mutual funds or exchange traded funds or individual stocks and bonds. Those typically provide the fuel that you need to meet the objectives that your clients have. And so invest in those, because that's probably the most predictable, the least volatile way to help a client get to where they want to go. And so if you can get it done in those types of vehicles, then by all means, it typically makes sense to do that. And I'd say the third thing is this idea of don't be a forced seller. Don't artificially be a forced seller. So make sure that you've got the diversified portfolio. Make sure you've got ample cash reserves to weather any temporary setback, whether it's you lost your job and it's taken a while to find a new job, or whether you're retired and you don't have that income coming in from a job anymore, and instead it's been replaced with a retirement income plan. It's been replaced with ample cash reserves. So if you've got a good advisor who's walking you through all of that, then these times of turbulence in the markets are actual times of opportunity. And those may be times when you want to put a little bit more into the market and take advantage of things being on sale. So those to me, I think, are three key takeaways. Either one of you have anything you want to add to that, or any other takeaways for today?
I think it's been a great session of looking kind of deep into what's happening with some of the detail, and then kind of stepping back and looking at a longer term historical perspective. And I'll always default back to, even a lot of our listeners and viewers know that we have somewhat of a specialization in working with folks from engineering, construction, and architecture type companies. We have a specialization in understanding a lot of the nuances, or most of the nuances, around ESOPs, those types of retirement programs. Although we work from folks in every industry, we do have a decent swath of our client are from engineering firms. And so while I always say the engineer is an interesting type of person to work with, they have high standards, they're detailed, they're focused. They want you to see that you're doing what you say you're doing, that you have a detailed, disciplined process that you're actually following, that it's consistent, which is very important for the operation of any project, or heck, the operation of a safe flight, or any type of a building or construction project, anything in life, actually. But even some of the smartest, folks with engineering backgrounds that we work with. And again, there's people that are smart in all industries. It's not only engineers aren't the only smart ones out there, but even those folks will come to us, Steve, and they'll say, you know what, I've built this wealth over many years, and I'm realizing the serious nature that this has to last the rest of my life and my family's life. And I've been emotional about it at times. I'm going into retirement now, and they're smart enough to know that they may be even more emotional because they've never been retired before. To your point, that just not having the money coming in from work, it's now coming in from their investment portfolio, but they've never been retired before. So there's a question mark about how they might emotionally respond to not only market downturns, but even markets going way higher, or having a family issue, or some combination of those things, or a health issue, or those types of things. And they say, we want to delegate this. We want to have somebody that has a disciplined, proven process to help us with it, even though they may have the brain power, if they really wanted to focus the time on it, to do it themselves. But they've decided they want to delegate because they don't want to take that risk. And so interesting, to see how that all kind of plays out at the intersection of all this. So great. Appreciate you both putting together another very fine episode today. For a good portion of our episode, I know our listeners and viewers might have noticed, but I was just a spectator for probably about 20 solid minutes of that. And I was actually getting kind of spoiled by that. I thought, man, you guys are making it easy on me today. I didn't have to say a whole lot in that middle piece.
Mm-hmm.
All right. Happy to do it. Well, Bill and Matt, as always, thank you. I appreciate you guys being part of this and putting these out. So for each of you listening, if you have not already subscribed to the podcast, please do that. Please tell your family and friends about it. We want to continue to have more people listen to these episodes, watch these episodes on YouTube, so that we can continue to make America literate again. How about that? We'll just make America financially literate. So the great objective there.
That's right.
And and if you want to learn more about Keen Wealth Advisors, please visit us at keenwealthadvisors.com. So thank you, and we'll catch you on the next episode of Keen on Retirement. The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.